Operating a business in the UAE or the wider GCC often involves a bad compromise. Your finance team runs an English system for reporting, while your HR and operations teams maintain separate Arabic forms for payroll, contracts, and staff files. This setup works until you look at how a single transaction is actually processed. To meet local requirements, your staff has to pull data out of the system and start building disconnected workflows by hand. You enter an invoice once, but the data splinters. Finance builds an Excel sheet to fix Arabic tax labels for VAT. Operations retypes property descriptions into a Word document for a bilingual contract. HR moves payroll data into a separate portal for the wage protection system. By month end, names don't match and item descriptions are shortened differently across these three paths. Someone now has to verify if the Arabic output produced outside the system still reflects the original accounting entry. When the same transaction exists in two different languages across disconnected files, the business relies on manual reconciliation rather than a live record. Control begins to slip at the exact point where the data leaves the system. It is easy to mistake an Arabic menu for a bilingual system, but there is a massive difference between a localized business platform and a translated screen set. These fake bilingual systems give executives false confidence. While the dashboard looks fine, staff are often secretly maintaining parallel records inside spreadsheets to satisfy Arabic document requirements. The cost shows up in the daily grind. Month-end close takes longer, payroll questions go unresolved, and contract reviews slow down because the wording has to be manually checked for every single version. You end up paying senior team members to check formatting and word choices instead of verifying figures or making decisions based on reports they can actually trust. If your team still retypes Arabic descriptions or corrects printed output after the transaction is posted, your ERP is fragmented. It is a source of operational risk rather than a solution. To see if an ERP handles GCC operations, you must inspect the underlying mechanics. The first technical requirement is the Unicode Bidirectional Text Algorithm, or BIDE. A serious GCC ERP must process mixed language data on the exact same line. Standard software just right-aligns the text, which scrambles the output. Proper BIDE architecture ensures Arabic and English inputs render correctly together on the same invoice line without breaking. Requiring deep BIDE support restricts your software choices. Many global SaaS platforms fail this test, which pushes you towards specialized local vendors who built for this operating environment from the start. The second architectural necessity is operating from a single, unified bilingual database rather than separate language silos. In this setup, your English-speaking finance team and Arabic-speaking HR team work simultaneously on the same live record. No exporting, manual translations, or mismatched documents. Achieving this single source of truth requires disciplined data governance. A business must first standardize its terminology and clean its records before migration to ensure the output remains consistent. This architecture is what allows you to survive heavily regulated workflows in the GCC, starting with UAE VAT scrutiny. This invoice demonstrates how native systems generate audit-ready Arabic VAT documents directly from the live English transaction, securing the chain between the original entry and the final document. The stakes are equally high in human resources. Disconnected payroll calculations and Arabic employee records create discrepancies that trigger delays with the wage protection system. Strict ERP compliance removes the dangerous flexibility for staff to manually tweak Arabic PDFs or templates outside the system. Tying your compliance output directly to the live, uneditable transaction is the only reliable way to defend against audits and prevent payroll rejections. This brings us to a strategic procurement choice. Do you try to customize a rigid global platform or adopt a natively developed system like Hinawi? Closed platforms leave you trapped by a distant vendor's roadmap. If their system cannot handle regional lease structures or local contracting norms, you are forced to build workarounds outside the software. Working with a local vendor who owns their source code changes the strategic outlook for the business. Source code autonomy allows the system to reflect complex local logic, like project retentions or factory costing, to match exactly how your company manages its costs. This ownership is a commercial protection. It ensures your software supports your operational growth instead of limiting it. A warning tone. A native bilingual ERP will expose every inconsistency in your historical data during the first month of operation. You cannot treat Arabic and English as optional labels. Migration requires forcing chaotic legacy data into aligned digital records before the new system goes live. This means standardizing customer names, aligning bilingual account structures, and locking down spelling formats before import. If you carry old confusion into the new system, the automation will fail. You also need role-based training so that your team understands the new document rules. The goal is to eliminate the dependence on a single bilingual employee to fix forms before they are sent to a ministry or a client. The upfront effort of this data alignment is the necessary cost to permanently eliminate the daily operational debt of manual rework. This final tool helps determine if a native bilingual system is the right investment. For English-only satellite offices without local compliance needs, a bilingual upgrade is unnecessary. But GCC enterprises dealing with BAT, WPS, and mixed language teams sit firmly in the native ERP zone. For companies in this high-risk quadrant, Hinawi ERP provides the bilingual architecture required to maintain a single accounting truth across accounting, HR, and real estate. In a market that runs in Arabic and English daily, true financial control requires treating both languages as part of the transaction itself. Anything less creates an operational debt that grows every month.